Good afternoon, everyone, and thank you for joining us on today's webinar, MLPs, What's Next? My name is Will Hershey of Yorkville Capital Management, and joining me today from Yorkville will be Darren Schringa, founder and CIO, and Jim Hugg, portfolio manager. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box in the bottom right corner of your screen. We'll hold a Q&A session at the end of the call, and we'll do our best to answer everyone's question. With that, I'll turn the call over to Darren.
Thank you, Will. And thank you all for joining us on our quarterly call. The first slide really epitomizes where we're at today, and it's energy and MLPs are starting to show signs of strength. I think if we would add one thing, we could have said finally to that, to emphasize the point. We're going to start by analyzing a look at just what's going on with equities first, and then we'll talk about fundamentals again, because we now see that equity prices are starting to catch up with fundamentals. And as Warren Buffett once said, that over the short term, equity markets are a beauty contest, which means they're extremely subjective, and you can have a disconnect between fundamentals and equity prices. But over the long term, that the equity markets are a scale, and they will weigh strong fundamentals with the appropriate valuation. The markets are efficient long term. So our belief has been for the past year and change that we've had fundamentals improving, both from a macro perspective as well as at a company level. Balance sheets have been strengthening, earnings growth has started to come around, coverage ratios were going up, and still equity prices were going down. So let's look at equity prices right now. We're starting to see some sunshine come through the clouds for energy equities and MLPs specifically. The first slide, top 10 drawdowns of 2018, MLPs have become a relative safe haven. Now that's a change. If you look at energy companies over the past couple of years, really since the great energy recession of 2015, MLPs and energy stocks have been under pressure, some for fundamental reasons initially, but have not picked up on the improving fundamentals. So MLPs and energy would have been leaders on the downside. So the first thing that we need from a technical perspective to show signs of a market bottoming in a turn is sellers need to be spent. You need to get rid of the investors who have grown fatigued of the asset class, that are either short selling it or long owning investors that have thrown in the towel. So you need to get rid of the people who are shorting it, number one, and you need to get rid of the long owning investors who have just said, I've had enough and I've passed my threshold of pain, and they don't view energy as a strategic allocation in a portfolio. So this slide is looking at the 10 worst periods on a daily basis for the S&P 500. So as volatility has started to emerge its head or reemerge recently in broader U.S. equities and global equities, you've seen drawdowns or drops in the S&P 500 on the left side of over 4%, and to the 10th best of the worst day down roughly 1.5%. The green bar is your MLP performance as measured by the Alarian Index. 8 out of the 10 periods where the S&P dropped, MLPs outperformed. So that indication, again, is an indication that sellers have been spent. On bad days when people are throwing in the towel now in other equities, so whether it's S&P 500 or NASDAQ, your energy sellers aren't there. They're not showing up, which would make sense because energy is starting to become a value play where the other asset classes have had a 9-year bull run and valuations are getting arguably a little more stretched. So sellers are spent, the number one point for a market bottoming. We've seen that in the down days. The second, and really equally as important as having sellers spent, you need to have signs of leadership. You need to have new buyers come in, because the buyers who are sellers of the asset are probably not going to turn around and get right back in and buy it again. They've been burned and are frustrated and will sit on the sidelines, maybe never getting back into energy or maybe getting back in when they feel the coast is clear. So you need new buyers to emerge. And we've seen that here. What this line graph is looking at, it's looking at the energy index, which is the S&P 500 energy sector, XLE, and then the S&P 500 SPY. As you can see, the top line is your energy stocks, and we're just looking at over the past, really from the end of March through April, the past month, because this is how recent the turn that we're seeing, and on a year-to-date basis, actually. But we're just looking short-term here. So you've started to see your energy sector outperform your broader markets right now as measured by the S&P 500. That's good. And we would hope to see that, and we're waiting for that because, again, as new buyers are coming in and starting to pick up the yield on MLPs and just the undervaluation, the value play that MLPs represent, less risk, we're seeing that on the downside. Now more opportunity for upside relative to downside. And when you look at MLPs coupled with an attractive yield. So sellers are spent, new buyers are coming in, we're seeing that in terms of outperformance. And the next part is we bring this back closer to home for us is MLPs. As you can see, XLE is the top line, the gray line, and the green line is the Alerian Index. Energy stocks are outperforming. Again, we're looking at this on a year-to-date basis. You actually are starting to show energy being slightly positive, and this goes through 4/16, so this is really fresh data that we're looking at here. Energy is showing positive on the year. It's outperforming the Alerian Index, which is still slightly underwater now, only around 5% down on the year. The important part is, generally speaking, and what we've seen recently is the cyclical energy names are leading. They led on the downside. When we came into the recession in 2015, the great energy recession, MLPs held up for a number of months, and then MLPs turned over with the energy sector. We've seen energy names bounce first, which we haven't seen this happen yet, and now MLPs are following them on the way up. So again, a number of factors are starting to point to a bottom being put into the MLP asset class from a technical perspective. Finally, we look at the price performance, and this is in the month of April. Again, all these slides that we've been looking at have focused on April. The Alerian Index, the first one, is up 9.9% on the month. An incredible month. It's slightly on the month outperformed XLE, which is up 9.7%, and now the S&P 500, which is having a good month in and of itself, up almost 5%. The energy complex is producing 2x the performance right now of the broader market. Putting this 9.9% month in perspective, once you get over 10%, you start to get into the top 10 months of MLPs ever. So if it felt bad on the downside, on the upside to the good, this is almost mid-month right now, one of the best months we've seen to date in MLP history. So we'll see how the remainder of the month plays out. The next part of our talk, this is the first part again was just looking at why we think a bottom is being put in, and bottoms are put in based on technical reasons. And sellers being spent, new buyers coming in, and we're seeing indications of both of those things as I discussed in the slide. The second part is MLP fundamentals continue to improve. That's something that we've been speaking about for, over a year now, and probably longer than that, since we've seen signs of fundamentals bottoming and starting to improve on a macro level, and then again on a company-specific level. So if we look at our first slide here, U.S. oil inventories, drawdowns in 2017 and 2018 now. I was at an investor conference with existing investors, and someone said, Darren, this was a year ago roughly, what should we be focused on? And I said, the problem which led to the great energy recession of 2015 was an oversupply. And what you should be focused on is inventory levels, because our analysis shows that the OPEC cuts are enough to balance the markets. And if that's the case, then we should start to see inventory drawdowns. And that proved to be, we were absolutely right. And there's a good life lesson in this for me and as a firm. We learned that although we were fundamentally right, we called the turn in inventories and the market being undersupplied and ultimately the oil prices going up in response to that. From a stock perspective, we were absolutely wrong. The price performance of MLPs has continued to, until late, the signs we've talked about, trade off, although the fundamentals were improving. So again, we talked about the disconnect. We're just waiting for signs that the market was again going to start pricing the fundamentals correctly. So looking at this chart here, basically the 2017 line after the first quarter, so from 4/1 through 12, almost every single period of time that you see the line, the bar coming down across what is called the x-axis, which is your time, shows a draw. And if you look at the dotted line on the bottom, that's the maximum draws that we've experienced since 2000. And most of the time, or many of those periods of time, we experience maximum draws, or quite often. And that was indicative of being fundamentally right. Inventory levels were, and OPEC cuts were working. And what's incredible is U.S. production was growing through this period of time too, and inventory levels were still coming down. So again, that's part of the story of the U.S. energy revolution I'll touch on. So we made this call last year, early in the year. We told our investors to focus on it. We publish these statistics on a regular basis. And oil inventory levels have been drawn down consistently. We're through the first quarter. We'd expect to see draws again. And we heard from API last night there were draws on oil again. EIA came out with their numbers today. Again, further draws. Oil prices are trading at
high since 2014 levels, right?
Yeah. So what's going on fundamentally is working on a global basis of bringing the market back into supply. The second part of it is just another way of looking at inventory levels. This is the 5-year inventory levels is something that OPEC's been focusing on. When do we get to our 5-year levels? And as you can see here, the black line is our current inventory levels from early 17, basically after the first quarter. If you look at April there, a little before, you started to see inventory levels decline dramatically through the end of the year into 2017. Have flatlined a bit versus building this year, because the first quarter is generally a build period, and now we're starting to see inventory levels decrease again after the second quarter, which goes with seasonally. If you look at the lines, they start to trend up historically, where this year they were flat in the January 18 in this first quarter onward. So in spite of the U.S. increase in production, which has been significant, we're at record levels of production, inventory levels have continued to come down. That is supportive of global oil prices, because if you're not producing it and there's no inventory, your spot price will go a lot higher, or at least be supported, because there's no additional supply to sell from inventories. Inventories coming down. This is the macro story, supply and demand for any commodity. If you have too much supply, your price of your commodity will go down. If you don't have sufficient demand, and again you're oversupplied, your price will go down. When you have a balanced market in oil and in global energy prices, you'd expect a price of the commodity, in this case oil, to be moving up. And we look at February 16th, which was really the bottom of the market, when at the end of the great energy recession, and it really was a great energy recession. We don't want to forget that. It was as bad as 08 for energy investors. You've seen really oil moving in one direction, and it's been moving up from the lower left to the top right. And as Will pointed out earlier, it's at the highest levels we've seen since 2014, which was before moving into the downturn of 2015. We don't expect oil prices to hit $100. That's not what our forecast is. We think the 55 to 65 range, which is where we've seen oil settle pretty much from the fourth quarter of last year through current, is a good range. It may overshoot a little on the upside, but ultimately that's not our forecast on what entails a healthy market for energy companies in general and MLPs specifically. But the price of the commodity has been moving up again, should be supportive of energy companies, and so we're starting to see that now with the outperformance. really important for MLPs is production levels. And this next slide demonstrates better than anything that well, number one is if you look at the current number that we're producing at record levels in the history of the United States, and that's going back into the 70s?
1970s is the last time we were over 10 million barrels.
10 million barrels. So the country is as prolific in producing energy as we ever have been, and then from the 70s through the mid-2000s, we were on a declining production curve of oil, and then when fracking came in and unconventional shale plays, the energy revolution was born in the United States. So if you look at that from 2009, we've basically, in less than a decade, doubled our production levels, which is incredible, and it hasn't been a smooth rise. You can see the energy recession in 15, we dropped by 500,000 barrels, and now we're increasing again back up in 17, and now we're at record levels. 2018, we see a forecast this is from EIA, of 10.7, which will be a new all-time high on an annual basis of our production, and then a new all-time high again in 2019 of 11.4 million barrels. So the U.S. energy revolution, which began in the mid-2000s, is alive and well in the United States, and it's measured by production levels. We're not only producing record levels of oil, we're producing record levels of natural gas, we're producing record levels of LNGs, and now NGLs. So there's just every fundamental macro area of the industry that could be firing on all cylinders is firing on all cylinders, but that's been the case for quite a long period of time. The equities haven't responded, and so the fundamental backdrop remains stable. That's why we see this rally is not a head fake, but a continuation based on strong fundamentals. There was a piece that was published. The IEA comes out with their monthly report on what their outlook is, and one of the statistics that we haven't seen before is the forecast for U.S. production growth of oil over the next couple of years. They forecast the U.S. will bring on another 4 million barrels. So if we go from 10 million barrels to 14 million barrels, that's a 40% increase. That's going to require a lot of infrastructure to be built in order to handle an additional 4 million barrels coming on of production out of the United States. So the U.S. remains the largest U.S. energy, the largest producer of energy on a global basis. We are only growing in power in that perspective. That means to me that production levels increasing is very beneficial to MLPs, because MLPs are primarily the toll roads that move molecules from the wellhead to the end user, and the number of end users, the demand side of it is even growing, especially since we're exporting LNG at this point, as well as oil and as well as NGLs. So our ability to sell more of our production has even increased. That really does redound to the benefit of master limited partnerships and the ability to need to develop more projects to allow the industry to expand it by 40%. And I would say the expansion would even be greater than that, because we're not including natural gas, we're not including natural gas liquids or liquefied natural gas in these calculations. This is strictly oil. So that's a huge number. From an investor standpoint, again, the fundamentals, the energy revolution is alive and well. Don't think anything's slowing down from the U.S.'s perspective right now. We're producing these levels of production, record levels of production, at this point on par with Russia and Saudi Arabia, the two largest oil producers on a global basis. And we are still seeing inventories being drawn down within the United States, so that's indicative of a balanced market. Moving from a macro to what we call micro, which is looking at company fundamentals right now, and this is looking at median growth in the fourth quarter on a year-over-year basis. For the entire MLP universe, which is all publicly traded master limited partnerships, distributions grew at 2.4%. Across the entire universe. The EBITDA, which is a estimate of cash flow, which is more indicative of the operating performance of companies, grew at 11.4%. And the reason for the disconnect of 2.4% distribution growth and 11.4% EBITDA growth isn't so much that business fundamentals aren't healthy, because EBITDA grew by over 10%, by 11%, but it's that there's been a structural change in ETFs. As we've talked about before, the coverage ratio, which is the amount that the cash flow produced by the partnership covers the distribution, the higher that ratio is, the more cash flow you have per unit of distribution, the safer the distribution is, the less likely the partnership will have to cut its distribution. So what MLPs have been doing, generally, is they have slowed the growth of distributions down in order to increase the coverage ratio. So ultimately, the income now that MLPs are producing is arguably safer than it has been historically, because there's a larger coverage of distribution. So the underlying businesses are strong, growing at 11.4%. Distributions have been slow because MLPs are not increasing their distributions, but they're increasing their coverage ratios. And with an asset class that's yielding 9% currently, there's not a whole lot of need to increase distributions at this time until valuations come back in line. So we've seen a little bit of a shift that, again, benefits investors because the asset class has been de-risked at a company-specific level. If you look at infrastructure companies alone, not the entire universe, you see a growth rate of 6.1% in distribution, so much higher than the average growth rate overall from the entire universe. Now getting to valuation. This is one of the reasons why new investors come into an asset class as other investors exit. One, you have to have strong fundamentals. There needs to be a reason to invest in something. If it's a falling knife, that doesn't bring investors in. And number two, the valuations need to get attractive to bring in new money. And what you see here is we're looking at our MLP yields versus historical averages. There have only been 2 periods where yields across the asset class have been higher than where they are today. The first one was in the 08 through 09 time period, which was the Great Recession, and that was a recession that was caused by the real estate bubble bursting in the United States that had a global tsunami effect. The second one was the Great Energy Recession of 2015. These 2 periods of time are when yields were higher than where they are currently, but outside of that, yields have never been at these levels. So from an entry point, in investors who have bought into MLPs at peaking yields when the valuations are low, it's proven to be a good time to enter the asset class on a historical basis. So valuations are supportive of bringing new investors in, specifically value investors. They tend to be the first ones to come into an asset class when it's forming a bottom, and then you move into more growth-oriented and momentum investors as the valuations become more frothy and growth becomes clearer. So we're in the beginning stages of a recovery here on valuation as well. Clearly not stretched, and in fact very favorable. One last point, it's been asked me before, why do you use yield as a valuation? Is it still accurate? On a historical basis, yield has been the most predictive of all valuation metrics on future performance of MLPs. So we want to look at valuation metrics which are predictive of what, as best as it can be predictive, of what future returns look like. And if you want to look at one, focus on yield more than any other metric. So high yields, good returns post that, generally speaking. We look at yields in another way here, trading above utilities and REITs, which are other income equities. And you can see a couple of things here, and I'm going to focus on the downturn again of 08 and then the energy recession of 2015. What the line means when it spikes is that, in this case, MLP yields went up and the other asset class yields stayed relatively stable. So what you see in relative to utilities is in 2008 period of time, MLP yields from the previous graph spiked. Utilities held their value a lot better, and their yields did not spike as much. So your spread between utilities and MLPs spiked. At the same time, your spread compressed between REITs. And why is that? Well, because REITs actually suffered very similarly to MLPs on a fundamental basis in the 2008 downturn, the Great Recession. And you saw yields on REITs spike like you did on MLPs, and that the valuation, as you can see from a zero, they actually got a little bit worse even on REITs than they did for MLPs at the low of 2009. So what does that mean when you come here and look at 15, 16, 17, and now 18? The only time that spreads relative to MLPs for both utilities and REITs have been higher was in 2008 and 15. So on a relative basis, MLPs are extremely attractive. Again, two other periods of time. Looking at the individual asset classes between utilities and REITs, if we did enter into a global downturn, REITs have a lot further to fall. If they repeat the pattern that we saw in 2008, their yields will really blow out, which means the only thing that gives if income is held constant is the price needs to drop a lot in order to bring your yields up. So from a evaluation perspective, and that means from a risk perspective, REITs are a lot riskier right now than MLPs are when you look at that factor and pricing in what's a worst case scenario. So we've seen some of that year to date in the performance as well between the two asset classes. Finally, Will?
Just one thing to add to the overall discussion of yield and how we look at it for MLPs, and especially compared to REITs in particular. REITs are forced to pay out 90% of their income, right? So effectively, they're covering their distribution, if you will. In their case, it's dividends 1.1 times. MLPs, as they're moving towards this MLP 2.0 model, 1.2 coverage, 1.3 coverage, the yield even that you're seeing on the screen of 9%, which is tremendous, actually the distributable cash flow yield, or what they could pay if they wanted to take things to 100% of their cash flow, maybe 10 or higher, right? So just wanted to point that out as well.
Great. Thank you. The final slide that we're going to look at here in terms of valuation and opportunities and trying to quantify risk and return is our upside-downside capture ratio. And what we have looked at here to come up with, well, what's the downside relative to the potential upside, is we took yields that we looked at in the previous slides. We looked at what was the peak yield in the worst case in 2008 or 15. It actually would have been 2008. So that was the MLPs drop to bring the yield up to X, and that is indicative of downside of 30%. So if MLPs had to go back to their maximum yield that they saw in the height of the crisis of 2008, it would be implicit of a 30% downside, which we aren't pricing in a catastrophic event. We think that MLPs are already relatively cheap, and especially are absolutely cheap and are definitely relatively cheap. But still, that's the downside potential. There'd be a lot more downside potential in the S&P 500, in REITs, and even utilities at this point, I believe. So the upside potential is saying, okay, over that same time period, what was the minimum yield that MLPs received? And you apply that on future distributions, and you come up with what the upside index level would be to reach minimum yields. And so what you're finding between these two extremes is a continuum. You have 30% downside and 67% upside. So you have 2 times, based on historical yield valuations, 2 times to the upside versus 1 times to the downside. That's a good risk-return environment. And again, investors who have gotten into MLPs when the risk return was like this, which is essentially saying when the valuations are where they are currently, it's been a good time to be an MLP investor. They've been rewarded with good returns after that. And it's not just MLPs, it's buying any asset class. There was a friend of mine who once said he was a real estate investor, right bought, half sold. If you buy any asset cheap enough, you're going to make money on it, almost. And so this is what you're getting at. MLPs are trading at a discount on a historical basis and on a relative basis. So we're going to move on to the performance of our strategies. Clearly, we've tried to make the case that there are signs here of a bottom being formed due to sellers being spent, new investors coming in. The macro backdrop has remained in place. We've seen inventory levels come down, which is the direct response to the OPEC cut and direct response to the oversupply that the oil market had experienced on a global basis because of the United States and our newfound production capabilities. The second part of it is that fundamentals across the asset class at a company level are improving. We can see that through EBITDA growth rate of 11%. So now, how's Yorkville performed in the midst of everything going on across the asset class? And we'll look at our next two slides where we look at the growth opportunity strategy and then our relatively new MLP high income strategy, which now is approaching 3 years soon. So it's not that new anymore. Our growth opportunities strategy is really, in a nutshell, performed over the 1 year period on a trailing basis in line with the Alerian Index. That is an improvement. We actually had some of the worst underperformance in our history at midpoint last year relative to the Alerian Index. We've closed that gap nicely over the last 9 months here. Essentially, the reason for the underperformance is not that anything's changed at Yorkville. This is a growth strategy. So we are investing in MLPs that have the highest growth potential, or more specifically, the highest quality growth. And again, we look for MLPs that have a very low probability of cutting their distribution, clearly identifiable catalysts for future distribution growth. And again, over our history through the 2 downturns, we've had no MLPs that have cut their distribution. So we're good at stock picking. We're good at identifying high-quality growth names. What's happened overall is that growth has been out of favor. So as the asset class has come out of the bottom and had a recovery, the first investors to come in are generally value investors. As I mentioned earlier, they're looking for yield, which makes sense. If you're early, you want to get paid to wait. So yield plays have been the better place to be from an investment standpoint in MLPs. They have outperformed, whereas you'd expect growth to start to outperform as you move into sort of the middle innings of MLPs and of a cyclical or secular recovery, which we believe we're entering into, which we have been entering into on a fundamental basis, and now we believe that the company's stock prices will start to participate in which have already been a relatively strong macro and fundamental improvements. So inline performance, close the gap. Why are we only doing in line with the market is really because Alerian Index is not a growth index, it's a broad market MLP index. We're growth investors within that. Growth has been out of favor and value has been more in favor. We would expect that to change, and we've closed that gap a lot over the past, again, 9 months. So, and then from inception over the Alerian Index, we're still generating, and the inception here goes back to January 1st of the index of 2002. So that's, we're now into our 16th year of performance on this index. We've seen a lot of different market cycles as investors in MLPs, and I think I've mentioned this before. This is, I think it's the longest index in existence. If not, there may be one who came out near us, but if not the first, then I believe it's number 2 anyway. We've been doing this. We are pioneers of investing in MLP. So still generating alpha over our performance, and actually this is one of the least amounts of alpha we've ever delivered in our history. Our fundamental checklist for the MLP growth opportunity strategy, are we delivering on our growth metrics? Absolutely. If you look at EBITDA, again, that's the operating health of the company. Our average EBITDA was 18.1% growth for the holdings as of March 31st, 2018. That's a year-over-year number relative to the Alarian Index, which grew at 9.3%. So the index is doubling the growth rate of the broader MLP market. Very important. Some of the studies that we've done on a historical basis have looked at the composition of return, income plus your growth equals your total return. So you're going to grow your principal either by having lots of income, high income, or lots of growth. And historically, growth has been a larger contributor of total return than income has across the MLP asset class. Depending on when you are in the cycle, up to 80% of the returns have come from growth over income for MLPs. So for us, we've always looked at the asset class over our history as a total return investment strategy that you really want to focus on price appreciation, which is driven by growth of distributions as your primary investment focus in MLPs. And we're continuing on a fundamental basis to deliver that type of alpha, 18.1%, 0.3%. Again, we believe that strong fundamentals exhibited by our companies over time will close the valuation gap, that they will be rewarded for being best of breed in terms of growth across the asset class. The same way we've seen a disconnect between strong fundamentals in energy and energy stock prices, which is starting to close. We would again expect growth to outperform over this next cyclical upturn. The second part of the second strategy we're going to look at today is our high income MLP strategy. We're looking at it through it's through March 31st here. Performance numbers. What you can notice on the bottom, again, high income gross versus Alarian gross, up 10.8% versus down 1.8% since we went live with this, which is roughly inception date is October 2015. So we're coming up to our 3rd year anniversary this year. It's a significant outperformance of almost over 10% alpha relative to the index. You can see that on a year-to-date basis and a quarter-to-date basis, both have been outstanding, and 0.9% or down roughly 1% on the year versus down 11% as of March 31st. Here is, again, on the year, almost 12% alpha. Well, it's almost right. And then on a quarter-to-date basis, it's the same as the year-to-date at this stage because it just went through the first quarter. So trailing 1 year, 10% alpha, again, down 10% versus down 20%. And this is an indication of 2 things. The first and most important from your perspective, if you like MLPs and you like the fundamental backdrop and you like the de-risking of the individual partnerships structurally due to lower leverage and higher coverage ratios, and you like the valuations, right now is the time to get in. So that's one part of the equation. Then who should we invest with? Well, you want to make sure you're dealing with someone who has the ability to, or has demonstrated the ability historically to generate alpha by being a good stock picker and risk manager. And we clearly have done that. So nothing that we've done has changed. You can see that we deliver alpha here. Part of the difference is that as I mentioned earlier, value, yield has been more attractive to investors. It's outperformed. We've even outperformed the broader benchmark. And so the high income strategy is an interesting strategy for investors that maybe are interested in MLPs, want to tiptoe into the asset class, but are still not convinced that this is the bottom and would like to clip some income while they're waiting. As you can see, on this slide, the distribution yield is 12.8%, so over 12% yield versus 8.8% on the Alerian index. So you're getting 50% more income while you're paid to wait is one of the ways we like to look at it. So the high income strategy is something for investors who, again, are maybe coming back into the MLP asset class, are looking for alternative sources of income as a long-term hold. We're applying our same fundamental stock picking skills here. And instead of looking for high-quality growth is what we're looking for in our growth opportunity strategy. Here we're looking for high-quality income. So, and we're delivering fundamentally on both of them, 50% more growth, 50% more income, essentially, across both strategies. So nothing has changed at Yorkville. We are experts in investing in the master limited partnerships and energy infrastructure companies. We are agnostic to whether it's a C Corp or an MLP structure. We like the quality of the underlying assets and the cash flow, stability of the cash flow that they produce due to long-term contracts. So that wraps up my formal comments. And in summary, once again, we believe, and let me say this, we're starting to see signs that a bottom has been put in across the asset class. Why? Protection on the downside. MLPs are not dropping as far as the broader markets. That's an indication that sellers are spent. We've seen now leadership from energy names on the upside. That means new investors are coming back in, driving up the price. Why would new investors be coming in? Because the fundamentals are in place. We've seen the macro story we called inventory levels. We're going to be drawn down. Inventory levels were drawn down all of last year. That was supportive of the price of oil, which is good for energy names specifically. We've seen the price of oil move up from the lows of 16, the bottom, through current, and is trading at highs not seen since 2014. The U.S. production levels have continued to increase. We're producing oil at record levels. We're producing natural gas at record levels. We're producing natural gas liquids, liquefied natural gas, all at record levels across the country. And it means we're going to need a lot more infrastructure. If the IEA is right, that we're going to increase production by 40% over the next couple of years, the energy revolution is alive and well. There's no country in the world that is as low a cost producer as the United States to bring on incremental supply of oil, and certainly not in natural gas. We are the low-cost producer on a natural gas. So energy long-term still is a good strategic play in the portfolio for the investors that have held on through the downturns. The signs are very positive right now of a turnaround in the asset class. You've seen the performance this month, and we believe that, again, the disconnect between fundamentals and valuation will close. So if the market has been a bit of a beauty contest of late, and that's very subjective, we believe now that it's becoming a scale and is going to weigh fundamentals and risk. And on the scale, MLPs are going to be found to not be lacking. So that finishes my comments, prepared comments, and Will, let's open it up for questions.
Great, thanks, Darren. As you just mentioned, we'll now start the Q&A portion of the call. If you weren't here for the brief intro, if you have any questions that you'd like to have answered, just type them in. There should be in the bottom right corner of your screen, there should be a Q&A tab. And we already have a few, so why don't we start, GM, why don't we start with you here to give Darren a little bit of a breather. We have a question, and the question is, will we continue to see roll-ups in the MLP asset class, and what do they mean from a tax perspective, and how should we look at them? And just before Jim answers, I just want to point out, if you're not familiar, really what this person is referring to is the consolidation of parent companies, whether they be general partners or larger companies, rolling up their MLPs. So, Jim, what are your thoughts there?
Well, I really don't think that there are that many left to be rolled up. But let me just touch on a couple of things. One, there are tax implications if a if an MLP is acquired and it's by a C corporation, that's a taxable transaction. And you will pay a long-term capital gain on assuming that you have a capital gain on it. But the really thing that might hit you pretty hard is of course the recapture of your distributions that you've received over the years. But I really don't think that there are too many left. And the reason, to give you a little more background on this, the reason why there are these roll-ups. Years ago, when we first started to get involved with with this asset class, it was that if you really wanted to buy the growth investments, you would buy the general partner, because they have what they call these IDRs, which I'm sure the people on this call are familiar with, these incentive distribution rights. So you would buy that, and you would get the kick in that, and the MLP you would buy for income. Well, that was all fine and good until it really started to impact the MLP's cost of capital. So this is what it's really boiled down to. In order to solve this cost of capital problem, or to alleviate it, they've done these roll-ups, but there's been several of them. Tallgrass being the latest one, but I think we're kind of getting down to the ones that are going to be done have been done. There may be a few more outstanding, but I think we've seen pretty much the end of this. I don't know if Darren or Will, you want to comment any further on that?
Yeah, I think maybe the case where you have a publicly traded general partner that's in and of itself a single entity, and an MLP limited partner that's in a single entity, there may not be many more of those to come, but I think the trend of simplification of the structure, and this, I'm actually going to tie this into one of the other questions, which was, with all of the positive fundamentals that you showed us, how come price performance lagged? And I think part of it is a result of the simplification that's taking place in MLPs, where, and Jim touched on this briefly, but where you're getting a more institutional investor base that is not a fan of the general partners taking a large portion of cash flows, where they want to see self-funding. And I think part of the kind of growing pains that we've been through over the past while here, and maybe part of the reason why price performance hasn't followed the fundamentals till just recently, mainly April, is a kind of a changing of the investor bases. We continue to see MLPs and midstream companies, as they become more and more incorporated as C corps, really kind of a larger portion of the investor base moving towards institutional, which really, that's a process that takes time, right? I mean, you've historically had MLPs really be primarily retail held. So I think simplifications and improvement of the structure from a corporate governance perspective, a lot of that's happened, a lot of it's going to continue to happen, and those are positive catalysts that could still come into play. I don't know if we want to add anything, but I think that's important to note. So
just one other thing and Darren touched on this in his presentation, but the coverage that we have now is probably the highest it's been, or certainly very close to the highest it's ever been. Investors, I think, are going to start to notice that and will like it, because what it means is self-funding, or you're not going to have as many equity offerings, and which from my standpoint and from Yorkville's standpoint, we like that, and we prefer that instead of the EBITDA growth that Darren mentioned was 11% plus, and yet the distribution growth was only, what was it, 2.1% or whatever the figure was. So I think investors are going to start to appreciate what's going on, and you're going to see less equity offerings, and as a consequence, I think that the yield will come down, or another, i.e., the stocks will go up.
Great, thanks, Jim. Next question here, switching gears to more macro, Darren, maybe you can take a try at this. In terms of the production levels that we showed, are these levels sustainable, and how long can the U.S. continue to produce at these levels?
So are the levels sustainable? Yes, they are sustainable. And why would I say that? Because if you look at the amount of reserves that we have relative to production, we have 50 years of reserves in oil and 100 years of reserves in natural gas based on current production levels. Those are rough figures, but those are pretty accurate. So they are clearly sustainable for a long period of time. In fact, you could ramp growth a lot and still have multiple decades, which is probably for most of us here more than our investment horizon, the remaining investment horizon that we have. So the levels are sustainable. The levels can actually grow. The bottleneck that we'll see will be the infrastructure to move oil and natural gas. We're already seeing that in certain basins like the Permian. They need more pipelines to be built to what they call offtake, so that they can get it out of the basin to the end users. And so I see that as being really more of the bottleneck, not is this unsustainable. No, the energy revolution is alive and well, and for the foreseeable future, we've made a statement again here. When oil was back at 9, we said our forecast of the U.S. will produce 16 million. We can see that in possibly even 20 million barrels of oil. And those are unheard of numbers, but now you're starting to see even the IEA, which is based out of Paris, coming out and saying, well, another 4 million. Well, that's going to bring it to 14 million barrels. So that's closing in on the 16 million barrels. So the ability of the U.S. to produce and continue to produce, we are the low-cost producer, and in a commodity-based business, that's your #1 competitive advantage. If you are the low-cost producer of the commodity, you're gonna set the price. And so any incremental supply coming on, and let me restate that, we're the low-cost producer of incremental supply. There are cheaper fields that still exist in the world that produce oil at whatever it may be, $10, because they've been producing for decades now. But any new production is not coming on it anywhere. And again, as we mentioned a lot, offshore it's $100 a barrel. So offshore is not going to need to come on as long as the U.S. shale plays can produce it at this $50 to $60 range, and the prices are coming down. So that's such a favorable macroeconomic backdrop when you look at energy and a position in your portfolio as sort of a long-term hold, because you're picking up on something that is been so disruptive, which is the U.S. energy revolution on a global basis. It caused the great energy recession of 2015, which is negative, but that's just, I think, again, that's growing pains of just how does the U.S. fit in as a net energy exporter or an energy exporter and a growing producer versus a net energy importer and a declining producer. So it disrupted the power on a global basis, and now it's settling in on how OPEC has responded to it. Clearly, prices in the 20s and 30s didn't work for any OPEC nation. They were running budget deficits at a country level, not at a corporate level. For the U.S., it's only at a corporate level when energy suffers. So low energy prices didn't work. We've seen enough statements on that. $70 Brent price is now what's being talked up. And
yeah, and actually more recently, we even saw the Saudis come out and say 80 on Brent is what they want to see. Maybe they'll just keep ratcheting it up until they finally IPO Saudi Aramco, but who knows when that's going to come, because we've been hearing that for a while. But one point that Darren made that I just want to highlight, because it's really important, is Darren pointed to the need for oil infrastructure in certain parts of the country, and that we're already seeing it. So what we're seeing in places like the Permian is oil prices are trading at a several dollar discount to WTI, the benchmark that we commonly refer to in the U.S. And the reason for that is there's simply not enough capacity to take away how rapidly production has grown. And that's going to continue to be the case, and that's going to mean new projects for new MLPs that are going to have to build new projects, really, ultimately, not buy. In this case, it's going to be build new pipeline capacity. So just wanted to highlight that as a really positive sign that we haven't seen for a few years at least.
And one one other point, Will and Darren, and that is that, I think there's always some concern by investors. Well, we're going to continue to ramp up production, and what are these? What about the other countries? Aren't they going to come in? And there are some positive things. I mean, and I look at this and kind of it doesn't make me happy to see what's happening in Venezuela, but what's happening there is that the country is being run into the ground, and we're going to continue to see declines in production from Venezuela. Iran, I think that Trump is probably going to renegotiate this deal that we had with Iran that was put through under the Obama administration, and I think that's going to result, I think, in people not investing, countries not investing in Iran and supplying them with the oil equipment that they need. So that's another area or another country that you may not see a big increase or an increase in oil production. And the same thing with Russia. The problems that we're having with Putin are for real. And again, I think that our exporting LNG, which Darren touched upon in his comments, one thing about Trump, whether you like him or not, the fracking rules that the easing that he did on that has been a very powerful weapon, and it has really hurt Russia. So I think that the fact that we're going to be increasing our production because of the shale revolution, I don't think it's really going to be offset by these other countries. So I'm reasonably optimistic about what's going to happen to the price of oil, even though we don't try and forecast it precisely.
Great, thanks, Jim. Next question here, and I think we'll have maybe a couple more before we wrap up at the top of the hour. What is the impact to MLPs of the FERC ruling, the FERC announcement? So I'll start and then feel free to chime in. For those of you that weren't aware, FERC, which regulates all natural gas pipelines and all interstate liquids pipelines as well, oil, that being oil, ultimately came out with a ruling, I guess it was mid-February now, and important to note that we've actually rebounded on the index to recapture all of the losses we had post this announcement. But ultimately, what they came out with and said is the pipelines that we're regulating, the way that you can charge rates to your customers is based off of a formula for what your return is, like similar to a utility in that sense. And MLPs historically were allowed to include taxes in that calculation. This was going back in the courts for probably 20 years. And ultimately, they reversed that to say you can't include a tax allowance in the calculation because you're an MLP, you don't pay taxes. And we saw this impact a very small portion of, and we don't want to get too far in the weeds because it's kind of hard not to on this topic, but ultimately, what do we see as the impact? There's certain contracts and certain types of pipelines with particularly these cost of service contracts that are primarily from when shale started, because most of the contracts nowadays are negotiated or market rates, that the MLPs will be impacted. There's no question. We actually had a handful of names that came out and stated impact to cash flow. And in those cases, the MLPs and maybe assets that are at the parent that were slated to drop down don't make sense anymore. But I think really important overall, this was a blip for a small portion of the asset class, number one, and then even within that subsector of the asset class, a small portion of those companies' assets, apart from a handful of companies where, they'll really be impacted. So I think the FERC announcement was kind of, in some ways, the last, hopefully, we don't want to call it, but hopefully the last piece of bad news that finally, we had our last burst of selling and short selling following the announcement. We've since recovered all those gains. That maybe that was just the last piece of bad news to come, but really not a major impact for the MLP asset class. So moving on to our next question, and then I think after this we're going to call it, given that we've taken your time here, and I think let's find a good one to end on. What did we see? Let's see here. What's the reason that U.S. energy independence did not result in MLPs outperforming the S&P 500? Was it related to supply and demand, or what was it exactly that maybe hasn't resulted in MLP performing yet?
Right. Energy independence became the negative for the MLP asset class for this reason, that we're creating too much oil on a global basis, and we being the United States was producing too much oil on a global basis. That ended up getting the markets into an oversupplied situation. There was more supply of oil, primarily almost 100% from the U.S. relative to the demand growth. So when you have an oversupplied situation in a commodity, the commodity collapses. So the energy independence it was alive and well, and actually energy independence, as measured in the production of oil, was the cause for the collapse in energy. So it was both a positive and a negative. So short term, the markets on a global basis had to figure out how to treat the United States. How do we treat this low-cost supplier of incremental oil, and not only of a couple of 100,000 barrels, but seemingly can bring on millions of barrels almost to meet global demand for the foreseeable future out of its production until we get bottlenecked by infrastructure, and then we could see a price spike again, all things being equal. So that's the reason why we were too successful in our energy independence, and that caused to an oversupply on a global basis. And essentially from 15 through right now until to 18, we're starting to show signs of now these bottoms that we spoke about on the conference call. Energy's been it's been a really painful place to be in, unlike the rest of the market, where equities have continued to rally from their 09 lows to current. We're into a 9-year bull market. Energy had a 6-year upturn, and then it had a downturn as bad, and now hopefully we're seeing signs of a price upturn. We've already seen fundamental upturn. So long and short of it is, we were our own worst enemies. We supplied so much energy on a global basis. We were able to bring up so much energy on. We're still able to bring on, as IEA said, another 40% increase in production. So there's very few industries that you can look at right now as an investor that have a macroeconomic growth profile of MLPs going forward. Again, I love this. I'm going to conclude with this. Short-term markets get things wrong, right? It's a beauty contest. It's extremely subjective, and it's fear-driven, and fear is not logical. Long-term, the markets are really quite efficient, and they become scaled. And when you put on the fundamentals of MLPs on the scales and the valuations of MLPs and the simplification, the lower leverage, the higher coverage ratios, and probably most important of all of that, just the valuation at this stage. When you buy MLPs at these valuations, historically it's been a good entry point with good returns for investors for the foreseeable future. So I leave you on that. The ice is starting to thaw for MLPs. There are signs of that now, that this freeze we've been in since 15 is starting to break, and we're seeing new investors come in. Prices starting to go up, getting support on the downside. They're not dropping as much. We're starting to see price leadership on the upside, and the fundamentals have been improving over the last few years. They continue to improve. So, for you investors who have been with us and stuck to the asset class, thank you. It's been a painful experience. We're making a call here where we see some signs of a bottom. We can't call a bottom, but there are indications of it, and certainly on a fundamental basis, that bottom was put in a couple of years ago. So please call us if you have any individual questions. If you're interested in investing in MLPs, maybe high income is a good way. If you haven't been in the asset class, get paid to wait. If you want to speak to us about anything, your portfolios, please do give us a call. We'd love to catch up with you. And until next quarter, thank you for your loyalty. We're here because of you. So
great. Thanks so much.